Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
Hey, Howard.
Q, what's new with you?
Do you think we're going to need to bring a change of clothes? Because this will be...
Are we looking too formal?
Well, I don't know. I guess you're going to insert different episodes, but these will be like back to back to back on YouTube, so we're wearing the same clothes. Meaning
in future weeks.
Yeah, videos. We're going to be showing multiple videos. And
people will think we only own like one shirt.
If you have no idea what we're talking about, we have not live videos. Oh, that'd be cool to go live. Oh, that'd be awesome.
You're like scheming.
Oh. Anyways,
video.
You can check us out on YouTube, DIY Money Podcast. You can see the podcast. And we've not done this for a long time. I think we were ahead of our time. I mean, let's just face it. Years ago when we had somebody doing this for us, we were putting them up. And they were great. They were produced exceptionally well. And like 3 people, like my mother, your parents, checked it out. And that was it. And I was like, how is this possible? We have like 10,000 audio downloads. Nobody went to watch the podcast on the video. Now, when you say podcast to people, do you know most people are like, oh, yeah, I watched that. I watch your podcast. I'm like, we don't even have videos. Like, what are you talking about? So they don't even associate podcasts with audio only. It used to be only audio only. Right? Now it isn't.
Back in the day. What are your thoughts? This is a similar concept, but I'd be curious. Do you think if you listen to the audiobook, I had this debate a couple weeks ago, is that reading? Like, would you say I read that book?
I would say I read that book, actually, and then I always say, actually, I listened to it.
Okay.
So
I agree.
Yeah.
But I have friends who were trying to argue that if you listen to the audiobook, you can say, I read that book.
No.
Like, no, you listen to that book.
Reading is an act of, like, something you do with your eyeballs.
We're in agreement
Listening is with your ears. Like, I listened to that book. Would be, if you wanted to just have one sentence, I listened to that book. Mm-hmm. And previously, people would be like, what are you talking about? Now it's like a normal thing.
Oh, yeah.
Yeah.
I do not do audiobooks because I can't focus long enough. Like, if I'm going to listen to something, I'll listen to music. But if I'm going to read, I want to, like, read it so then I'm not distracted and I can picture what's going on and all the things.
Yeah. I usually have an audiobook going in my car, Spotify. I love it. I love it when the author reads it. The last one I listened to, I almost said read.
That would have been bad.
That would have been funny. The last one I listened to was 1929 by Andrew Ross Sorkin. Great book. Phenomenal. And I listened to it and he read it and he did an exceptional job with that. And it was really good. Here's what I don't like. You didn't ask what I like or dislike.
What don't you like,
But
Quint?
I started a new book recently, and in the first paragraph, the guy said, this book is best digested in one setting. So carve out however many hours and digest it all at once. I closed the book. I set it aside. I don't know if I'll pick it up again.
How long was the book?
I mean, it's a normal book. Like
a few hundred pages?
Yeah, like, I don't know. I'm holding up my fingers here for those of you listening to video. I don't know. Like a book.
Okay.
Like a book. Like
so
several
a few
chapters.
Hours to read through
I'm not going to carve out a few hours. Now, I probably will disagree with him and just start reading it anyways, but it annoyed me. I was like, how dare you try to monopolize 4 hours of my day right away? Like, I just met you. I don't even know you. It was a book recommendation from somebody I do trust, but I don't trust this person to give them all this time right off the bat. No way.
Fair.
Anyways, it bothered me.
Let's hard pivot from that and talk about our sponsors.
Yes, let's take a break for our wonderful sponsors. All right, welcome back. Yeah, if you're watching the video, we got this new thing we do in the sponsors.
You wouldn't get it if you're not watching the video.
You gotta watch the video.
I have FOMO.
Yeah, gotta watch the video. Now I'm totally lost. I don't even know what else to talk about. Check us out on all the socials, DIY Money Podcast. Send in the questions. We're not yet doing the video questions that Allie came up with the other day, so that's not a thing.
No, we won't do that for a while.
But we're going back to the classroom today. We're going back to the classroom. So what are we talking about today? Howard. By the way, pause, time out. This is episode 900.
Oh, that's a great thing to pause for.
This is 900 episodes. I did the math the other day. Someone was asking us. We're like almost 10 million downloads. 10 million downloads. That's a lot.
Mm-hmm.
So thanks. And I know people listening that have listened to every single one. So talk about trust. I won't give the guy 3 or 4 hours of my time. Some people have given us.
I would recommend listening to everyone back to back.
Just carve out a week.
Carve out a week.
Carve out a week. I mean, carve out a week. But sometimes people are like, I binged them. I'm like, bravo. That's awesome.
Fair enough.
900 Unbelievable.
Yeah. I think for 1,000, we have to do something big. So if you have
Something big.
ideas,
Oh.
send it to podcast at
There you
DIYmoney.org.
go. Yeah.
With your questions. Did we
We'll
say
do
that
something
already?
big. I think I'll tell you what we'll do. I know exactly what we're
Oh,
going
boy.
to do. We're going to give for the 1,000th question, we might give $1,000.
You're
I'll
speaking that
sponsor it.
into existence right now.
I think we're going to do that.
Cash or Amazon gift cards?
I don't know yet.
You just
I mean,
thought
we
of it.
pay it no matter what.
All
maybe
right,
cash.
you heard it here first. If you are the honorary 1,000,
If we
we're gonna
use
do a
your
back,
question, that's what
we're
we're
gonna
doing.
just do it back
I'm
to the
putting it right
classroom
now.
for 1,000.
I'm putting it right
We're paying
now.
ourselves
No,
1,000.
what? That's like you not listening to the commercials, which I'm still bitter
joking.
about.
I'm joking.
No, that's what we're doing. I'm telling you right now. You heard it here on the 900th episode. If we use your question,
The golden question.
you will get $1,000 from DIY Money.
There you go.
So
Looking
I'll
forward
tell
to
you
it.
what. Here's what you got to do.
I'm sending in a
Send us a
question for
question, and we got to let us know you want it to be considered for the 1,000th episode. We have to know. So you got to say this, like you put it in the memo, like your email.
Golden question.
So there you go, and it needs
But
to
if
be
we
good.
use it before then, you just get the $25 Amazon?
Yes.
You're making up these rules on the fly.
I know I am. We
Okay.
have not talked about it. Yes, of course. Only for the 1,000th. When we choose the 1,000th question, they get $1,000.
And you're going to hand deliver it to them.
If they're local, sure. But if they're not, no, absolutely not.
I was just
All of
seeing
our
how
people
far
from
you take
Minnesota. Can
Seeing
we
how
get
far
to
you
back
take
to
it.
the classroom? So
All
you
right.
heard it. That's it. We'll talk about it. We'll talk about it, everyone. Get the news
Everyone
out.
for
Tell
the next
everybody.
100 episodes.
Yeah, it's going to
Okay.
be a long.
That's
how
awesome.
long does that
Looking forward
last?
to that
Not
in
long.
2 years. Okay.
2 years, three a week.
3 a week, 100 episodes,
So what's that? 12.
30-ish weeks.
Okay, so by the
So
end of
less
this
than
year.
a year.
Less than this year.
Probably around the end of the year.
Just tell us. We'll put them in the queue, and we're gonna select it too.
okay,
We're-
we got to
big.
get back
This
on
is
track.
big. This is
Logan is
breaking
giving
news.
us the eyes of no one cares about this anymore.
I care
Let's
about
go
it.
to the back to the classroom.
All right, go.
Today, we are going to be talking about behavioral bias, which is interesting. So we talk a lot in our business about how often money intersects with psychology. And so we kind of joke about it as a team, but sometimes in our job, we don't feel like financial advisors. We feel like either counselors or psychiatrists or some mix of the two, because there's so many mental barriers to overcome when you're investing. And we talk about them a lot of times when we're responding to the question, and we'll say, quote, "It depends." And then we'll go to talk about some sort of behavioral bias. But I want to talk through some of the ones that we see the most often, because what I have found in my own life is if I know these and I'm watching for them in myself and can call them out, sometimes you can course correct and recast your thinking. So Q, we'll kind of just bounce a few around. The biggest one I see, especially recently, we just came through this crazy dip and rebound, so we're cutting this kind of early. But when this comes out, I'm sure you will remember the period of time when the market declined rapidly and then got back up rapidly, and who's to say what happens after that? We talk about loss aversion. Okay, so what does that mean? Loss aversion is essentially the idea that when you're losing money, it hurts more than when you're gaining money. And practically, the way I see this with clients, without fail, and you are probably going to laugh when I say this, is, okay, Quint, do you have a guess? When an account is down, how does a client tell us about that?
In dollar terms, always.
Dollar bills. I do this the same way. When I'm looking at my account, oh no, I'm down $200 today. What in the world's going on? When the account is up, it's not dollars anymore. What is it?
It's percentages.
Percentages. And so that kind of plays on the idea, well, why is that? I think we have this psychological security piece that when we're losing money, we're like, oh no, there it goes. And you've joked when I don't listen to the ads, I'm throwing money out the window going down the interstate.
You literally are.
Sure. But that's how people view their accounts in our businesses. When it's down, you're throwing money out the windows going down the interstate. What is going on? You know how many times I've had a client call me and be like, I was just looking at my account today and I'm up and I just wanted to sing your praises and take you to a steak dinner? Zero. Because when the account is up, that's your expectation, right? You don't go into investing thinking, I can't wait for the day I lose money and I'm really going to, sit there and mourn when it happens. And so you think about this idea, okay, with loss aversion, how do I change my thinking? And I actually called my father out. He won't care that I share this. The other day, he said, "What's going on in that account?" I said, "Okay, let's talk about it. What do you mean?" He said, "Well, I'm down, I don't remember how many dollars, but I'm down $1,000 today. What in the world?" And I was like, "Okay, let's look at last week. How many dollars were you up?" Because that's investing. And so as you're thinking through this psychological principle, that's how I choose. If you're going to do dollars, you got to always do dollars. If you're going to do percent, you got to always do percent. What's one that you see often? You've been in the biz a long time.
Well, this is great. You articulated that exceptionally well. I think when I don't interrupt, you know that I'm letting you roll because you're doing really, really well. And you did articulate that very, very well. I do want to preface that whatever it is that we talk about, I think people need to learn who they are. And they can learn who they are by going through these periods, or they can do some self-reflection. And there's a couple of resources that I would like to, and we've talked about these before. One is called The Millionaire Mindset. It's a book by T. Harv Eckert. It's a little hokey, quite a bit of it. There's some hokey parts to it. But he talks about, and I have adopted this, and when I give speeches and talk to people, I share this, the money blueprint, how someone is wired to think about money. And that often will come from their history with money. And most people are not aware, number one, of their money blueprint, and especially they don't really reflect on it or where it comes from. And I encourage people to do that. Pick up the book. It's a great read. Read about the money blueprint. But a lot of what you're talking about, whether it's loss aversion or, concern of markets are just casinos or whatever it might be, or holding on to money too tightly or holding on to money too loosely or whatever it might be, comes from how you were sort of indoctrinated to think about money as a child. And you got to really understand that about yourself. Now, loss aversion, this topic, which I really like, there's been a tremendous amount of scientific studies about this. And I have read, the first time I read a statistic, it said something like a dollar loss, the pain of a dollar loss is equal to $2.50 of gain. Meaning you have to gain $2.50 to have the same sort of emotional response on the emotion scale as a dollar loss. Recently, I heard that's as much as 4 to 1. I personally am in the 4 to 1 camp. I know this about myself. I hate to lose money. Even if I haven't sold and I really haven't lost, I hate that when people say that too, because when my account's down, I've lost money. But you get my gist. I am confident it will come back. But I don't get the same euphoria on the emotional side when I gain. It has to be exponentially greater. That is a scientific thing. Like, that is a thing. The second resource, so just know that you're not alone. You're not alone in that feeling. We all feel that. The second thing I would direct your attention to, and this is I don't think I've ever recommended this book, and it is called Thinking in Bets by Annie Duke. Annie Duke was on path to be like a neuroscientist or a neurological brainiac. Okay, she was
person
incredibly
doing a
smart.
Thing.
However, she grew up in a famous poker family, and she was also exceptionally good at poker. If you know the name Annie Duke, she's not a neuroscientist or whatever. She's a professional poker player. And she wrote a book called Thinking in Bets, and it's a great book. It's a heavier read, but it's a really good book that I did read, by the way, not listen to.
Yep.
But in that, she says we have to understand the probabilities of outcomes, so that we always say, 20% chance of something happening, and then we get so shocked when it does. And she's like, there was 2 out of 10 times that would have happened. You just happened to see the 2 times. Why do I say that? The education about markets is what will help you through the loss aversion periods. And I can't stress that enough. If you are not willing to educate yourself about how markets go up and down and the probabilities of what can happen, then you are going to set yourself up for disaster. you're going to set yourself up for that loss aversion. So at some point in time, when the markets aren't open and you might be sitting around the table with your father, my encouragement to you is whip out that standard deviation table on his portfolio and be like, Dad, I want to take you through what will eventually happen so that when it does, you don't freak out and call me. Now, he might still call you and you go, Dad, you remember when I was at the kitchen table and I brought that out and there was this 2% chance that at certain point in time you could be down 30%? You remember that? And you told me, yeah, you understand that and you get that? We're there. We're there now. It's happening. Does it mean it's going to snow in July forever and it's back to winter in Kentucky? No, it doesn't. It just means we're in that time period where, it's a challenge. Now, I know, again, you asked for other things and I will share some other ones. And I think we should move. We don't have a lot more time, but I think we'll pick out is recency bias. I love that when it comes to investing. So take that and I'll chime in.
Yeah. Recency bias is basically this idea that whatever is happening will continue to happen. So it's actually a perfect segue. It's kind of the same analogy of, okay, now I'm sitting at the table with my dad. We're in the 2% worst case scenario. We're kind of looking at each other. It's this idea that it's easy to fall into the trap that, oh my gosh, the market's down 20%, it will always be down 20%. What are we going to do? When in reality, a lot of times what you need to do in those periods that times are volatile, and I don't want to discount it, it's difficult, you almost have to zoom out. And instead of looking at the 1 day chart that without fail feels to always be volatile, you zoom out and you zoom out and zoom out. And we do this with clients. And eventually we get to a 10-year chart and we'll point back at things like COVID that felt like the end of the world. We will never recover. And we're like, okay, if you squint really hard on this chart, you can see COVID. Here it is. And they're like, oh, where is it? Can you circle it for me? Because in the grand scheme of all of investing, 10 years, 50 years, whatever it might be, those things that feel really heavy and are difficult do become kind of blips on the radar.
I'll play, yes, spot on again. I play a little devil's advocate on recency bias and what I'm a little concerned about. As we're cutting this, middle of April, markets are now at all-time highs. They were selling off. We were going through a pretty significant drawdown. And in a matter of 3 weeks, the market's recovered at a speed we haven't seen in decades.
All-time highs.
All-time highs. I believe people are becoming very casual with the idea of sell-offs. And the recency bias they're adopting is how quickly markets will recover.
Sure.
And my concern is we are going to get to a point where we go through a real bear market that does not recover for a matter of years. And my concern at that point for people who are becoming accustomed to this V-shaped reversal, move to new highs in a matter of weeks, is they then say, well, this is different. This is not what I'm used to. This isn't what's been happening recently, as in the last few years. So this might be the end. I'm going to need to do something different. I'm going to sell out. This is clearly, et cetera, et cetera, et cetera. You get my gist. So my concern is just as you said, backing out the chart and looking at the upside, I also believe we need to back out the chart and realize there are time periods where markets do nothing for a very long period of time. And even though you might not feel that that's too recent, someone who's been in the markets for 25 years, I'm like, man, I remember a lost decade. I remember what that was like. I still feel it. And therefore, when it happens, I'll know, it's part of the business. It sucks. We could be on this show for many, many years talking about, we're still not back to highs. This is ugly. Hang in there, blah, blah, blah. But it's, again, part of the business. Let's touch on a smooth transition very briefly on one other one, the last one I would say, which is just somebody simply being overconfident and becoming sort of, through this recency bias, things are recovering quickly, markets are at all-time highs, becoming overconfident with their investment strategy.
Yeah, that's good. This is one I've fallen victim to. Around COVID, I remember picking some stocks, and at that point, coming out of COVID, not going into COVID. Coming out of COVID, it felt like you throw a dart, you make money, and I remember getting this big head. This is so easy. Why is everyone not doing this? Let's just do it again. And I remember investing quite a bit of money, and that was not the case for all of the stocks that I picked. So I think it is easy to feel that. And I like that you bring this into the recency bias discussion, because I fully agree that we have had very quick rebounds, and we've had clients consistently. I had one call me just a few weeks ago that was like, what's the point of emergency fund? Like, it's just going to come back. I want to invest my whole emergency fund. And I was like, time out. That's not how it always plays out. So I think there is this idea of overconfidence. Some of that, I think, is coming from the same seed that you're referring to, that we really haven't seen a very long, sustained bear market and had to feel the pain of that for a while. So you probably can speak to this far more than I can in that regard.
I only want to touch on this once, and then we'll conclude, and that is a brief story of my time trading at a hedge fund. And for a good, 6 months or more, I did zero trading. I observed, I executed on behalf of my partner. I watched, I learned, I'd throw ideas to him, etc. And I did nothing myself. And then I'll never forget, there was a day where there was an idea that I had, a stock that I really liked. And I pitched him on it and had done some homework on it. And he's like, yeah, let's take a position. And I was like, okay. And he's like, go ahead and take it. And I was like, oh my gosh, like it's my time. It's my time to shine. Like, all right.
Yeah.
So I took the position, and in short order, within the matter of days, the position was working well. We were making money. I was on cloud 9, and I was like, this is like, I'm the man. I mean, this is really to the bottom line of it was a meaningful position, bottom line, real money in our pockets. Like, this is really good. And I remember saying to him something like, how great it was. Like, this is amazing. And he got so frustrated with me. And I was like, what did I do wrong? Like, we're making money. He goes, we expect to make money. This should not be a surprise. I am not patting you on your back. We expect to make money. And I was like, damn. I don't know if you can say that on the podcast, but I was like, damn. So ultimately, I learned very quickly that I'm not going to get too high. I'm not going to get too low. We're going to go through the ups and downs, and I'm certainly not getting overconfident, because the 2x4 was always right around the corner in that business.
Let me add one more thing, if I could. I would say, remember, when you're taking those positions and individual equities, you don't just have to be right twice. Or, I'm sorry, totally messed that up. Don't have to be right once. You have to be right twice. And so I think in overconfidence, sometimes you pick a winner, it starts going up, and then you start to talk about it to your friends, and you're patting yourself on the back.
I mean, hopefully most of our audience is not buying individual stocks.
Sure.
I mean, that's not our audience.
Which leads me to the easiest way to diversify and reduce some of that volatility of having to know exactly when to buy in, when to buy out, which sometimes is more difficult, is using index funds. And that's how most people, the average investor, should probably be approaching
100%.
investing.
Let's
to
end it
not
there.
be overconfident.
That's great. Absolutely. So hopefully you found some value in this, and you can go back in a time where you might be struggling with recency bias or, overconfidence or, whatever, loss aversion. Those are all great topics. Remember, friends, the secret to wealth is pretty simple. Live on less than you make, invest the rest, and do so for a very long time. Make it a great one.